This talk will be a somewhat personal perspective on what I think some of the key issues are facing central banks and policymakers, and what we need to be paying closer attention to, and what I think we will be paying closer attention to going forwards. But I just thought we'd start off with some global risks. Now, in 2019, Hans Rosling published a book called Factfulness. It's a brilliant book that I highly recommend. But in that, he identified the 5 global risks we should worry about. And it's interesting to note that of those 5 global risks, number 1 was a global pandemic. So anybody that acts as though COVID-19 was some kind of black swan event that nobody could anticipate, point them to Hans Rosling's book, and you can see that this was what he thought was the biggest global risk we should worry about at that time. The other risks that he identified, financial collapse, World War III, climate change, extreme poverty, and then he can kind of cover his back by saying unknown risks as this 6th category, because of course there can be some black swans that we're not considering. But COVID itself probably is not a good example of a black swan. He even quotes, serious experts on infectious diseases agree that a new nasty kind of flu is still the most dangerous threat to global health. An airborne disease like flu with the ability to spread very fast constitutes a greater threat to humanity than diseases like Ebola or HIV/AIDS. So I think even though this is a few years old, we can still use these global risks that Rosling identified as being relevant for today. I'm also going to show you here a consensus risk. So this is a bit more recently. I put this into ChatGPT and asked what are the big global risks we should be worried about. And they are COVID-19 pandemic. It's caused significant disruptions to global economies, remains a major risk, mainly because of the potential for new variants, the speed of vaccine distribution, and the effectiveness of public health policies. The second risk is geopolitical tensions. So ongoing geopolitical tensions such as trade disputes, sanctions, military conflicts, disrupts global trade and investment flows. The third is climate change. The increasing frequency and severity of extreme weather events, as well as a transition towards a low-carbon economy, poses significant risks to the global economy, especially in vulnerable sectors such as agriculture, tourism, and energy. And then fourth, the risk is debt levels. High levels of public and private debt in many countries could pose a risk to financial stability and lead to economic crises if debt levels become unsustainable. Now, in other lectures that I give, I talk more about debt sustainability. You don't need to listen to me to read out what ChatGPT thinks are the 4 biggest risks at the moment, but I do think this is a really nice way to get a consensus view and to see what some standard concerns might be. David Smith in the Sunday Times talks about the 4 economic horsemen of the apocalypse, and I think this is quite a useful framework as well. He talks about how the global financial crisis then contributed to perhaps, but also preceded the Brexit and Trump trade wars. So if the global financial crisis kind of really begins 2006 with the subprime mortgage issues that emerged, 2007 was when that becomes a global problem. You've then got a bit of time until 2016 when Trump is elected and Brexit referendum result comes in. That kind of goes on until about 2021, a slight overlap there with the COVID pandemic that begins in 2020. And then 2022, you see Russian invasion of Ukraine. So those 4 kind of economic horsemen, those 4 big issues that we're still trying to deal with are the global financial crisis, the trade wars, the pandemic, Russian invasion of Ukraine. And then he also identifies potential new or the potential next horsemen of the apocalypse being US banking failures. So that's something to pay attention to and just consider whether or not that might be the next crisis that's heading our way. Now, I do want to provide my own perspective on this. And so what I'm going to go is 3 different macroeconomic issues I think we need to pay attention to. And they are, firstly, the need for better data. Secondly, the fact that persistent government deficits and debt will lead to fiscal dominance. And the third is a lack of mission focus in central banks. I think it would be very useful for us to all pay closer attention to the data methods that are being used by policymakers, to be wary of the rise of fiscal dominance, and then also to question this issue of mission focus. So I'll look at all 3 of these in turn. Firstly, in terms of data, I think one key trend that's happening at the moment is that central banks are looking for better data. This is a quote from an article in the Harvard Business Review that says, investors have identified the need for new informational tools in a post-COVID landscape that can enable them to understand the macroeconomic environment better and stay ahead of the markets. Some of the examples of what were unorthodox and occasionally private sector data were open table restaurant reservations, Google Mobility Index, and cross-border visitor arrival data. I think that there may be a deeper problem, which is that we can't make better policies simply by having more, quicker, faster data. I do think that there is an interesting element in that big data has happened and yet it hasn't really followed through into more effective decision making. So there's an open question about whether or not there's simply a lack of data and we need more data as a solution. I would argue that maybe the solution isn't more data, but better methods. So maybe using scenario planning as an alternative to forecasting might improve decision making. But as an input into that decision making, economic data is very important. And I think there is this emerging trend now where people are starting to look at what type of data the private sector is creating and how that can feed into better quality decision making. Now, in terms of fiscal dominance, I just want to start by talking about the main objectives of aggregate demand management. So if we think about what policymakers are supposed to be doing, the prime directives of monetary policy is to control inflation, and fiscal policy is to manage public debt. Now, these are what can be considered, I think, to be the kind of the traditional areas of focus. Traditionally, we would split monetary policy and fiscal policy because we have our elected politicians engaged in fiscal policy. We have independent central bankers engaged in monetary policy. And ultimately, the objective is to make sure inflation is under control and that public debt is manageable. If those two things are in place, aggregate demand is reasonably stable, the economy tends to grow as well as it can, and we avoid major crises and negative economic shocks. This economic framework is incredibly important because the claim is that if these prime directives are met, this can enable and provide the kind of the landscape for other things that we want, which are also very important. Things such as strong real growth, low unemployment, financial stability, a just income distribution, national defence, other things like this. Now, those other objectives are important. The claim here is that monetary policy and fiscal policy are not necessarily the best tools to deliver them directly, but if we ensure that aggregate demand is reasonably stable and that monetary policy and fiscal policy are effective, then those other objectives can be achieved. They may require other policy in order to achieve them, but one thing that we do know from many examples throughout history is that if those prime directives are not met, if monetary policy is out of control, if fiscal policy is out of control, if we have unsustainable public debt burdens, if we have very high hyperinflation, then there's virtually no chance that we're going to be able to achieve those other objectives. The issue, though, is which of those directives should dominate. In a world of monetary dominance, which is really this kind of traditional world that I'm looking at here, the idea is that fiscal policy is focused on trying to ensure that public debt is manageable. Monetary policy is directed purely at inflation, some kind of inflation targeting regime that the central bank would do. So in a monetary dominance world, the monetary policy is actively controlling inflation and fiscal policy is passively stabilizing debt. So fiscal policy is responding to what monetary policy is doing. Monetary policy takes dominance. It's focused on inflation, and then fiscal policy is essentially just ensuring that debt is stable at whatever inflation rate the central bank is committed to achieving. Now, the alternative to this is what we're going to call fiscal dominance. This is when fiscal policy is focused more on controlling inflation and using government spending as the mechanism by which they're affecting inflation. And monetary policy, as a consequence, therefore, has to passively stabilize debt. Monetary policy is not geared towards controlling inflation in a fiscal dominant sense. Inflation is something that's generated by the policymakers, and monetary policy is geared around just dealing with the debt that's created as a consequence of that. Now, we want to point out that there are differences between monetary and fiscal dominance. Ultimately, monetary policy has much more power than fiscal policy. Generally speaking, fiscal spending is moving spending commitments between different time periods. It's only monetary policy that has the actual power to be able to create new spending year after year after year. And that's why most developed countries live in a monetary dominant regime. We had many experiments in the 1960s and 1970s where we saw poor policy making, lots of out of control inflation, lots of debt problems. And the generally accepted solution to that was for the monetary dominance to take place, for central banks to be independent, committed to controlling inflation, and not allow policymakers to issue too much debt and then have to resort to inflation as a means by which that gets funded. According to Willem Buiter, fiscal dominance is present when the central bank is forced to set its policy rates, fund the government, and engage in monetary issuance in ways that are incompatible with the pursuit of price stability and cannot be justified by financial stability considerations. So if monetary dominance is when central banks have the kind of complete control and freedom to pursue their monetary targets, fiscal dominance is when they have to subvert those and to deal with the situation that's being created by policymakers. Sargent and Wallace spoke about this in their classic 1981 paper. You can think of fiscal dominance as being when fiscal constraints prompt the monetary authority to abandon inflation commitments and to help finance government spending. Some prime examples recently include countries like Iceland, countries like Argentina. I'll also do a mini case study here of I think what is the best recent example of fiscal dominance, which is Turkey. In Turkey, President Erdogan wants to spend more money than can be raised through taxation or debt. And so this is the starting position. It's when government want to spend more money than they're able to generate through the traditional forms of government finance, which is taxation or debt. And then what happens is that you resort to the third type of government financing, which is inflation. He appointed 3 different central bankers within a 2-year period, trying to find somebody willing to help him. Whereas most central bankers are committed to controlling inflation and attempting to offset whatever fiscal policy decisions are being made. Ultimately, it's the president that calls the shots. They can hire and fire central bankers as often as they need until they have somebody in position that will facilitate and accommodate the spending that they want to do. Unsurprisingly, the consequence of this is inflation, and you can see here in 2022, inflation increased dramatically in Turkey, reaching possibly over 80%. It can be quite hard to measure instances of inflation when it's at these levels, but this is nothing surprising or shocking. As soon as you know that central bankers are being fired because the president wants more capability to be able to spend, it's no surprise that the consequence of that is going to be inflation. The outcome, monetary policy serves fiscal needs. This is the classic example of fiscal dominance, where monetary policy isn't controlling inflation, it's satisfying and serving fiscal needs and allowing inflation to get out of control. Now, this isn't just an emerging market problem. In a Mercatus policy brief by Eric Lieper, he points to 3 recent examples of fiscal dominance where we're starting to see even established central banks deviate somewhat from their monetary objectives and allow monetary policy to actually be accommodative of fiscal policy. The examples provided are the United States. So from March 2020 to March 2021, various COVID relief bills increased federal spending massively. These were treated as emergency gifts, which wouldn't need to be funded through higher taxes. If they're not going to be ultimately funded through higher taxes, you know that the burden will fall on the Federal Reserve and for the central banks to use inflation as a means by which this spending can happen. In July 2022, the ECB were authorized to buy sovereign bonds from specific member nations. It was widely viewed at the time that this was a means by which it would be able to help reduce Italian bond yields. So again, this is where Italian government borrowing is directing the pace of monetary policy. Third example of fiscal dominance coming to attention is September 2022. This is when the Liz Truss and Kwasi Kwarteng ill-fated and not long-lasting premiership in the UK, when they announced tax cuts and high fiscal commitments. This prompted a bond market crash. There's also a sterling crisis. The pound fell around 4.7% against the US dollar. The Bank of England responded by engaging in bond purchases as an attempt to stabilise the financial markets. And again, this can be viewed as an example of fiscal dominance where the decisions being made by politicians are forcing central banks to alter their behaviour, to deviate from simply trying to control inflation, to facilitate the difficulties being created by fiscal policy, whether that's too much spending or whether or not that's insufficient attention to how that spending is going to be funded. Now, there's a lice quiz that I created that asks you to try to guess what the areas of focus economists currently have. It's a bit of a rudimentary exercise, but based on a rough estimate of the proportion of sessions given at the 2023 AEEA meetings in New Orleans. So this is the most prominent economics conference, the American Economic Association, at their annual conference in 2023. A rough approximation of panels is, as you can see in this chart here. I've set this up as a quiz so that you can try to work out which topics relate to which. So we have climate, gender, growth, inflation, and race. The reason I think this is a useful exercise is that when you read newspapers, you tend to hear about economists being too much focused on issues such as growth and perhaps not enough on wider social objectives. The results of this are that the answer to part A was actually growth. So growth is in fact the area of least interest amongst economists. According to this survey, just 4.3% of panels were devoted to growth as the main topic. 7% of panels were devoted to inflation. 9% of panels were devoted to climate. Almost 13% of panels were devoted to race. And 15.5% of panels were devoted to gender-related issues. Now, this may be a surprise to think about how economists are focused on different topics. The point I want to make now is the extent to which this translates into central banks and the profession of economics as a whole. The question I'm posing is whether or not central banks are losing mission focus. So I'll talk about what I think their mission should be, but I do think it's clear that central banks are spending a lot of time thinking about areas that are traditionally outside their remit. Emerging areas of central bank attention include central bank digital currencies, inequality, and green central banking. Now, I have some lecture content on CBDCs and inequality elsewhere, so I won't spend too much time talking about them in this video, but I'll just briefly go through these three areas and talk a bit about what they are and central banks' attention. So this is a map of the world just showing that around 90% of global GDP, around 87 different countries, are currently exploring central bank digital currencies. So this is something that we can see has been a lot of interest in and is pretty widespread now with central banks, if not directly coming up with plans to implement a central bank digital currency, certainly devoting research attention to the consideration of doing so. In terms of inequality, we know that wealth inequality has risen quite recently. So this is just looking at the UK. You can see here the richest 1% now hold more than 20% of wealth in the UK, and that's risen quite a lot since the 1990s. But I will also point out that if looked in a historic context, there's quite a different picture because the richest 1% used to have over 70% of national wealth. So whereas we can see a rise since the 1970s, also in the United States, the historic trend has been since the start of the 20th century, dramatic falls in wealth inequality. Even though this is something that in historical context is not a major change or a major problem, this is clearly an area that central banks are more focused on, and so I would question whether or not that needs to be a dominant area of attention. And then the third issue I wanted to talk about was green central banks. In 2017, the Network for Greening the Financial System was established. The aim was to share best practices and contribute to the development of environment and climate risk management in the financial sector and mobilise mainstream finance to support the transition towards a sustainable economy. The Fed joined this in 2021. There's an interesting open question about how necessary these types of exercise are. Financial and climate change related risks are already part and parcel of central bank responsibilities. The really interesting issue, though, is monetary policy and to think how specifically green topics should be focused on when it comes to the conduct of monetary policy. The Bank of England and the European Central Bank have recently tweaked their mandate to include climate change related objectives. For example, voluntary corporate disclosures of climate risk are due to become mandatory. There's also stress tests based on climate change events. I think we can consider three main types of green monetary policy. So the first is credit operations. For example, you could charge banks different interest rates depending on how green they are. The second is collateral requirements. So you could apply haircuts tied to some kind of green rating. And then thirdly, in terms of asset purchases, when central banks conduct quantitative easing, for example, they can decide to buy more green corporate bonds or use that greenness as a factor in which bonds they're going to buy. What I've given here is a table that provides some criticisms of green central banking and some rejoinders. I've also tried to summarise what I think the key issue is. So, for example, some people would say there's no point having green central banks. You just need to ensure stability against all risks. So there shouldn't be specified risks that central banks pay attention to. All risks are important to guard against. A rejoinder to this is that doing so would involve increasing capital requirements, and that would be a drag on growth. And therefore, maybe it's a best thing for the central banks to focus on the specific risks that we're concerned about, to have a slightly more tailored approach rather than just raising capital requirements across the board. Personally, I think the key issue here is whether or not we should be using capital requirements in the first place in order to ensure financial stability. If you don't think capital requirements are the best way to ensure financial stability, then there's no necessity to increase them across the board as a means by which you're trying to manage against climate-related risk. Another criticism of green central banking is that it's the government's role to pick winners, not the central bank. So the central bank doesn't really have the democratic mandate or authority to be able to make these types of controversial decisions about which companies should be favoured and which companies should be penalised. A rejoinder to this, and this was made by Megan Green in a podcast in Macro Musings, the rejoinder that she made was to say that you may think it's the government's role, but if the government aren't doing it, then there is an important responsibility for the central bank to kind of step up and to do it instead. I don't find this a plausible argument, and the example that I'll give of this is that if Congress decide not to vote through increased military spending to help defend Ukraine, then very few people would say that that creates a kind of a moral or ethical justification for the Fed to remove its independence and to do that themselves. There's also the open question about where this kind of, what other types of social issues we should be focused on. So some people might think that climate risk is the focus point that we should have. Other people may say gender-related issues, and you could see from before that economists are more focused on gender than climate. Well, in that case, should it be the case that the Fed charges penalty rates on banks with high gender pay gaps? We have that data now. We can see what gender pay gap data is telling us. If we're going to be having different penalty rates for banks based on their different green credentials, why not also have different penalty rates based on how they do on other socio-economic indicators? The criticism, therefore, is simply to say that these are all issues that governments have a responsibility to participate in and to make these different trade-offs and priorities, but not necessarily an independent central bank. The third main criticism of green central banking is that it's too difficult to rate green bonds. The argument here is that it's somewhat arbitrary to come up with a rating system that is going to tell us what constitutes green behaviour or behaviour that isn't deemed sufficiently green. I think a good rejoinder to this, though, is that we use ratings agencies for this type of thing. And so we could say that it's impossible to be able to determine how risky the corporate debt being issued by companies are. But that's exactly why we have ratings agencies, to specialize in trying to reduce that risk to some extent and to provide some kind of justification. I think the key issue, therefore, is to see whether or not the agencies that validate green bonds are better at their jobs than the traditional credit rating agencies. If we think that traditional credit rating agencies are incredibly good at their jobs, then that's a reason why I think we could put more confidence in the ability to rate green bonds and incorporate that into our monetary policy considerations. But if, like me, you are somewhat suspicious of the capabilities of credit rating agencies, then that's an argument against expanding their territory and having more and more things being rated by third parties and then used as a basis on which commercial decisions are being made. So I've said that central banks have been increasingly concerned about things like central bank digital currencies, inequality, and green central banking. Now, if it's possible to be able to focus on multiple things all at once and you have a sufficient division of labour to do that, that's great. But a claim that I would make is that it's very difficult for organisations to achieve multiple objectives, and sometimes the question needs to be, what's the primary area of focus? What do we need this organisation to do? If that's the question for central banks, what should central banks do? I would argue that the answer is to ensure stable growth in total spending. And if they can provide that and successfully, then maybe it's worth asking about other priority areas that they can try to achieve. But if they're failing in their main objective, then that opens the question as to whether or not they should be losing focus on other things. Prior to the global financial crisis, nominal GDP growth, in other words, total spending, or this is sometimes known as aggregate demand, was around 5%. So you can see the nominal GDP growth rate here. It was roughly around 5% from 1997 to 2008 on average. Obviously, that goes up and down a bit from year to year, but there's a fairly good close consensus around that figure. Now, some people argue that this is why the economy performed reasonably well in this period. If you remember, this was the Great Moderation, where inflation was reasonably low, unemployment was reasonably low, we had a reasonable amount of financial stability, and the global economy was pretty successful during this period. And in the UK, the economy was doing well, and some have argued that the reason it was doing well was because nominal GDP growth was reasonably stable at 5%. We then see the consequence of the global financial crisis, where nominal GDP drops. It takes a while to recover. And then when it does recover, it's a little bit below what it was before. So from 2010 to 2019, it's averaged around 3.8% on average each year, as opposed to that 5%. So we've kind of dropped from a 5% to an almost 4% growth rate. And what's also important to recognize here is that the period in between those two, from 97 to 2008 and from 2010 to 2019, that growth was a permanent drop in the amount of nominal GDP being created. Now that point's more clearer when we look at the total amount of nominal GDP, which you can see here. You can see this kind of steadily increasing path up till 2008, 2009, when you can see it drop back. The key thing is to realize that it never recovered back to where it would have been. So when we can see that there has been a drop, which was in 2008, 2009, that reduction in nominal GDP growth never actually catches up to where it was before. Now, this is quite different from what happened more recently. So post-COVID, you can see like this kind of phenomenal negative impact on nominal GDP as a consequence of COVID, which is much more severe than the global financial crisis. But the critical difference was that in COVID, nominal GDP rebounded back above what it was previously. So we can see this again in the nominal GDP amount in the bottom. Unlike the global financial crisis, it did recover the growth path, and instead of having that kind of that blue line being permanently below the grey line, we can see that when it comes to more recently, if anything, it may have actually gone a bit above that, which might be a reason why we have some inflation at the moment. Anyway, the point I'm trying to make here is that some people would argue, myself included, that the reason we had a reasonably good economy up until 2008 was because nominal GDP growth was stable. when central banks allowed nominal growth to fall in 2007, 2009, and then had insufficient nominal GDP growth to get back to the growth path they were on before, this was a reason why we've had a very slow economy and we've had low growth from 2011 up to 2019. This is also an argument to say why the response to COVID has probably been a bit better than the response to the global financial crisis. Now, this is really important because the benefits of achieving nominal stability is that you don't have bank panics, you don't have debt crises, you don't have big rises in unemployment, and this is important because unemployment tends to lead to things like populism and all sorts of different political issues that arise from that as well. What many people, I think, neglect in the recovery of the pandemic is that remarkably we didn't see masses of bank failures. We didn't see massive explosions in debt levels. We didn't see massive increases in unemployment. The economy recovered reasonably strongly, and I would argue that the reason for that was because different policy making, which allowed nominal GDP growth to go higher than the average after the crisis, up until the point at which it reached the growth path. Now, when I look at this data, it seems to me that central bankers are doing a better job than they did previously. Maybe they learnt some of the lessons from the mistakes made in the global financial crisis, but we still have inflation targeting as the main focus of central banks rather than total spending. So I would argue that we need to make this more explicit. We need central banks to recognise that the success that they have is when they are thinking about nominal GDP. We need to make that an explicit target that central banks are supposed to deal with. And until we've done that and made sure that central banks are accurately able to ensure we have stable growth in total spending, we need to be careful about being focused and shifting our priorities on other matters. We can also see a similar story here in the United States. So this is using work by David Beckworth. What you can see here is the kind of the neutral nominal GDP growth rate, which is the teal line, and then you've got the actual NGDP growth rate, which is the orange line. And the main things to notice about this for the US is, again, like the UK, there's a significant output gap 2008-2009. The Fed wasn't doing enough to ensure that the economy had sufficient total spending. You can see that in the response to the pandemic, they managed to make sure that that was caught up. So rather than allowing it to seriously exist over time, that was a much more effective response. But the downside of that is potential subsequent overshooting. So if the criticism from 2009, 2010 was not providing sufficient demand in the economy, the argument here is that the Fed probably provided too much demand post-COVID, and that's why we're seeing inflation now. The ultimate point that I'm trying to make is that if central banks spent more time thinking about nominal GDP and trying to make sure that the growth rate of nominal GDP is stable and predictable, then we will be able to deliver many more social objectives that we have, and that until central banks are doing their main job, they shouldn't be too much focused on trying to do other things. There's a couple of links here so that you can see some of the references that I recommend that you look at. But I hope that video has been of interest.